The financial health of American farms is raising red flags. The latest figures on the U.S. rural economy show that the agricultural sector is facing a critical moment. According to the new quarterly report from the Center for Policy Analysis of Rural and Farm Finance, RFP, key indicators of farm financial health are in the high-risk zone. Generally speaking, the agricultural economy continues to deteriorate slowly, with several sectors showing signs of wear and tear. The survey tracks 14 financial indicators grouped into 4 main areas: farmer and banker, sentiment, farm income, and asset strength, agricultural machinery market, rural credit quality. In this assessment, U.S. agriculture received a score of 6.2 on a scale ranging from 1, low risk, to 10, high risk. The report combines market data and analyses by economists specializing in agricultural management and finance. In addition to measuring momentum, the change in figures compared to the previous quarter. The agricultural machinery sector is the most affected. Among all the sectors evaluated, the machinery market performed the worst. Used equipment sales declined sharply, according to data from the Association of Equipment Manufacturers, also impacting the financing operations of large producers. This weakening indicates that many farmers are postponing the purchase of tractors and combines, a classic sign of economic uncertainty in the countryside. Rising debt and income. Unequal, although the indicators show similar risks across the different segments analyzed, the report highlights an important point. Agricultural debt has been increasing, while average income varies significantly according to the type of production. There is a clear contrast between the performance of crops and livestock operations. Since 2022, the Federal Reserve Bank of Kansas City has been warning of falling rural loan repayment rates, a direct reflection of the financial pressure on farmers. Projections for 2025 reinforce this trend. Corn producers are expected to see a 14.8% drop in net cash income. Specialty crops, such as fruits and vegetables, are expected to decline by 1%. Pork and dairy producers may see some relief, with increases of 17.9% and 10.7%, respectively. Looking to the future and the challenges through 2030, researchers at the Agricultural and Food Policy Center, AFPC, at Texas A&M, University project a challenging scenario for the coming years, especially for rice, cotton, feed grains, and wheat, sectors that are expected to face fragile financial conditions through 2030. In contrast, dairy and cow-calf operations tend to maintain more stable financial foundations, indicating that livestock farming may continue to be the safe haven of the American countryside in times of economic instability. The signs are clear. The U.S. agricultural economy is facing headwinds. While livestock production is showing strength, crops are feeling the brunt of the economic conditions and tight credit. The warning has been given, and the future of agriculture will depend on how producers, lenders, and policymakers react to this scenario in the coming quarters.